So, what's going on with Prosus and Tencent? So I believe some of you do have vested interest in Prosus or even Tencent for that matter, because I've gotten multiple requests in my past videos for me to look into Prosus. So, why did I not do a video around Prosus before? Glad you have asked. For one, I think the entire structure between Naspers and Prosus is incredibly complex, and it's beyond my comprehension capabilities, to be absolutely frank. Because like you, I'm a retail investor who doesn't have a deep connection in the industry to really kind of understand and to explore the inner workings of such relationships. Two, for those of you who are interested in starting a position in Tencent in the first place, why not just buy the freaking stock instead of going through an intermediary? Also, it's not as if Prosus is trading via United States dollar, but is instead denominated in euros. There are so many layers of additional risk you are exposing yourself to, but that's of course just my own humble opinion. What do I even know? Oh, and one more thing. Not sponsored by the way, but I know many of you out there probably have not maxed out all the available sign-up rewards. Currently, stockbrokers like Tiger, Moomoo, and even Weibo have extremely aggressive sign-up campaigns that gives you essentially risk-free return. Where can you get something like that? Moomoo and Tiger Brokers is giving out cash coupons and even free shares, and if you're lucky, you can get a free Tesla stock. While Weibo on the other hand is giving out $100 worth of Apple shares, and you shouldn't allow all these 100% ROI deals get away. I'll leave the link to all these brokerages in the description box down below. So for most of you out there, I believe you guys were exposed to the idea of owning Prosus because of this super investor out there, Mohnish. He has been rather vocal about his position on selling Alibaba just last year for tax loss harvesting and switching it over to Prosus because he wanted exposure in Tencent. Now, the core argument for owning Prosus over Tencent is purely because they are undervalued. For one, if you were to look at the graph extracted from FactSet, if you were to compare the market value of Prosus versus that of the Tencent stake, Prosus was perpetually undervalued, and I mean it when I say perpetually. The funny thing is, I've came across many of such quote-unquote investment holding companies where their PB, which is price to book value, is less than 1, suggesting that their underlying book, which is the investments that they currently hold under the company's name, is significantly more valuable than the company's entire market cap that's trading in the free market. So for a fact, there are many of such investment holding companies in China with a staggering price to book ratio of 0.2 or even 0.3. Would you dare to buy them? At least for me, I don't, because I'm not going to bluff myself into thinking that hey, I know exactly what's going on behind the scenes and there will not be any shady arrangements between the subsidiary and the parent company, etc. But for Mohnish, however, he could probably have a better understanding of the structure behind Prosus, hence the investment. So just a side note, many of the said Chinese investment companies with PB of 0.2 or 0.3 were perpetually undervalued for the last 10 years. So I honestly couldn't figure out what was going on. Hence, I didn't bother looking into these said investment holding companies, and by extension, Prosus. Now, given the recent announcement, Prosus shares, which are down 27% year to date, jumped 18% on Monday. Naspers was also up 13%, while Tencent was down 1.5% in Hong Kong. So what exactly happened? In short, I believe that the markets were discounting Prosus exposure in Tencent on two counts. The first count is because it's a Chinese investment, and given how all the different Chinese equities has performed over the last 18 months, it's not too complex to comprehend why investors might want a larger margin of safety. The second count was probably because investors were skeptical of how much quote-unquote rights Prosus can exercise with regards to their Tencent exposure. So in the recent announcement where Prosus said that hey, they would start to drip Tencent stock into the market to fund an open-ended share buyback program, it essentially put investors' concerns at bay, that Prosus is not just a people holding company. Basically, they actually own shares that can be exercised, not just papers. However, the first rules still apply by the way. Don't forget, Tencent is still a Chinese company and the government can rug pull you anytime. Just a friendly reminder of course. Anyhow, for context, Naspers has been channeling Tencent's dividends into tech startups, mainly in emerging markets, creating a sprawling empire of e-commerce portfolio alongside its stake in Tencent. So you can very much view Naspers and Prosus like SoftBank, who also made it big with their Alibaba investment, where they first initially invested 20 million because of the fire in Jack Ma's eyes back in 2000, and that same stake is worth 78 billion today. So SoftBank is currently still by far the largest Alibaba shareholder, with around 24 to 25% stake. So before Monday's rally, Prosus shares were 53% below book value. You might then ask, why is it trading at such a huge disparity? To provide more color to the associated risks with such investment holding companies, I did briefly mention, firstly, such companies might or might not have a very complicated structure behind how they attribute the respective investments per se. Secondly, for international investors, you might be exposed to a certain degree of foreign exchange risk. The most important risk would involve management decision. So management of the investment firm, by the way, not the underlying security or companies that you own. If you were to look at this Tencent Prosus case study, the funny thing was, back in 2021, Prosus made the promise to not cut its stake for 3 years. I repeat, not cut its stake for 3 years. 1 year in 2022, and they decided to drip Tencent stock into the market to fund buybacks. I mean, technically, it's ultimately good for Prosus shareholders because it essentially unlocked real tangible value and all your portfolio will go up. But you are subjected to the changing management decision in this case. So I'd just like to remind all you potential or even existing shareholders of such investment holding companies to do your due diligence not only in the portfolio companies but also the management team psyche of the fund you are buying into. Personally, I think doing due diligence on specific companies are already a tough nut to crack, and jumping through extra hoops and additional hurdles will make it too complicated for my tiny brain right here. So if I want to buy Alibaba, I will buy Alibaba, not via SoftBank. If I want to buy Tencent, I will buy Tencent, period. Oh, and don't mix up such investment holding companies with an ETF or an index. They have different mandates and they have different objectives. So the big question is then, when will they stop selling Tencent? So the management only said that the program would last as long as the discount persists at discounted levels, which they declined to define, of course. Great, I guess it's part of the strategic ambiguity process. So of course, just joking by the way. So Sebastian, an analyst from Jefferies, said that between 10 to 20% would be normal for a conglomerate discount, but who knows how the market might take it. Ultimately, the share price of Prosus and Naspers depends on two things above all: where Tencent stock is trading and the discount to the book. So Tencent is of course beyond their control, but at least they now have a convincing strategy for narrowing the discount. So an additional point for investors, for those of you who actually remembered that Tencent declared a special interim dividend late last year by issuing out JD shares, Prosus by extension received a sizable amount of JD shares. And in Prosus' official statement, they said that JD.com does not form part of the group's core strategic focus, and the group has implemented an orderly disposal of the JD shares in the open market. I guess Tencent is also slowly losing its appeal to be part of the group's strategic focus as well. So like I cautioned, don't expose yourself to so much additional risk, but I believe many of you can argue that the discount was quote-unquote justifiable for the risk add-ons. I would just like to say that investing should be kept as simple as possible. This is not ordering a McDonald's meal. Having add-ons and going upsize might not necessarily always be a good thing. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!